Alright, so I'm Jeremy,
I'm Joel.
and we are covering the energy and utilities sectors. And so this is just a heat map of the whole S&P 500. The utilities sector is this little one right here. NEE is next year energy, and that's the one we own, so it's been doing decently well in the past year. And then the energy sector is up here. It's kind of included in the basic materials, but for the most part it's fairly green recently, so that means it's been doing decently well. Just an energy sector overview. The energy sector is comprised of companies that are involved in the production and refinement of oil and gas products. Energy companies participate in the exploration, drilling, refinement, transportation, and storage of oil, gas, and other consumable fuels. Companies that produce drilling equipment or provide related services are also classified in this sector. If you look at our SIF weighting for it, we're right in line with the S&P 500, so that's pretty good. In the past 5 years, the return has not been great. You can see by this chart right here, the red line is the S&P 500, the blue line is the energy sector. So basically from like 2014 to 2016, it really dropped off a lot, and it's slowly been recovering since then. In the past 3 years, it's had about a 15 to 20% return, but overall in the past 5 years, it hasn't done great. And it does better in the late stage of the business cycle, which is based off of analyst estimates. That's roughly where we are right now. So it seems like it should be doing fairly well in the foreseeable future. Two of the industries that are included, or it includes two industries, oil, gas, and consumable fuels, which has Chevron and Valero, which are two companies that we own in our portfolio, and then energy equipment and services, which are companies like Halliburton and Schlumberger, which we don't own. And it's classified as a sensitive sector, so it's not quite defensive, not quite cyclical. People still rely on energy even when the market's not doing well, but it definitely does better when the market is doing well. And then some risk factors in the oil, gas, and consumable fuels industry are geological risks. So a lot of the easy to get to oil has already been mined or drilled, and so a lot of the oil that they're having to go for now is harder to get to, and there's increased risks included in that. And because of that, there's also cost risks. They're having to drill in the middle of the ocean for oil, and so they have to make the barges in order to hold the drills. So those are increased costs associated with it. Some special metrics that oil, gas, and consumable fuel companies use are price per flowing barrel, which is the enterprise value divided by the barrels of oil equivalent per day. So you want to see a lower number for the most part. Depending on your enterprise value, it'll affect your numbers, but the lower the value, it means the higher production as in oil that they're producing each day compared to their overall price. They also use enterprise value divided by proven and probable reserves, and so proven reserves, there's a 90% or more probability that they'll be able to mine the oil and be economically profitable while doing so, and then the probable reserves is between a 50 and 90% chance. And they also use enterprise value divided by debt adjusted cash flows, and this is a similar ratio to price to cash flow, but a lot of these companies use debt to finance their costs, and so by using the debt adjusted cash flows, it kind of cancels that out, so you don't have companies that are in like $1 trillion of debt. It's easier to compare them to companies with only like $50 billion of debt when you adjust it for that.
So tell me a little bit more about those two metrics. For EV to reserves, what does this tell you about a company?
It tells you like kind of their prospects. So if they have a high or a lower ratio, so basically the lower that ratio is, the better chance that they have oil in the future, that they'll be able to mine oil in the future. And so it means that they'll be able to make money in the future by selling their oil that they're able to to mine. And then the other one is, so these are big projects having to drill for oil, and so they're having to take out loans in order to finance this, and the bigger companies are able to take out bigger loans, and by making it debt adjustable, you're able to compare them to the smaller companies that are taking out smaller loans, whereas just a price to cash flow ratio would be very skewed by a company that could pull out 100 billion in loans compared to a company that could only do 20 billion or something.
Yeah, so we definitely use that one with Chevron, but a company like NextEra wouldn't be as applicable, but
and then some emerging trends for this industry is the use of robotics for complex and repetitive tasks. So tasks like connecting pipelines, they're able to use robotics for. They're also able to like replace broken machinery. They can do that with the use of robots, and so it decreases their labor costs associated with that. And then they're also using 4D seismic technology to help scan for like deep water oil reserves, so they don't have to spend as much money to go through and actually drill down and try to find the oil. So that's saving them a lot of costs also. And then
they're also using the technology to deal with regulations and things like that. I know they just came out with these new, they're called pigs. They use them to run through oil lines and make sure that they're not leaking and things like that. And then they're also using the new technology to go into horizontal drilling instead of vertical drilling to reach the more difficult oil, like we were talking about earlier when they're doing explorations.
And then looking at their Porter's 5 forces, there really isn't too much threat of new entrants in this because of the large capital that you have to invest to get in, and also national oil companies already own or already control about 90% of the proven oil reserves in the world. So that would be companies like Saudi Aramco, which is owned by Saudi Arabia. And so it's hard to really, there's not a lot of market share to get in and be able to capitalize on, so it really discourages new entrants from joining the market. The bargaining power of buyers, there really isn't any at all. The price of oil isn't set by the demand for oil. Well, it sort of is, but it's set by, there's global oil benchmarks that determine the price. So there's the Brent blend, the West Texas Intermediate, and the Dubai Oman benchmarks that really determine the price, and so there's not a lot of wiggle room for buyers to change the price there. Threat of substitutes, there are a few, such as just changing to nuclear energy, solar, wind, that type of stuff, but there's not too much threat of that just yet. And then mainly it's just the competitive rivalry. There's a few big companies competing for small amounts of oil reserves, and so it's really just the competitive rivalry that shapes the market for the most part.
So Chevron is one of the companies that we have in the energy, and Chevron is engaged in every aspect of the oil, natural gas, and geothermal energy industries, including hydrocarbon exploration, production, refining, marketing and transportation, chemicals manufacturing and sales, and power generation. So basically they do it all. When you're dealing with oil, there's 3 major parts. There's upstream, midstream, downstream. Upstream would be exploration and finding the oil and mining it, and then midstream would be transporting the oil and then selling it to refineries, and then downstream is refining the oil into usable products like gasoline, jet fuel, diesel, asphalt, things like that, and then selling it. They're involved in all 3 of them, so they can make money doing that. Sub-industries, like we just said, they're involved in all of it. And this is them compared to the S&P 500. It's pretty similar to just looking at the energy sector compared to the S&P 500. They've been doing well over the past 3 years, but we're going to keep analyzing it to see how they're going to do in the future. And then we included the ratios that we talked about earlier to analyze them. Here's the debt-adjusted cash flow. It helped us out a lot because they do have a lot of debt right now. and it doesn't look like they're going to be paying it off anytime soon. You do want to talk about the...
Yeah, so some news that has been out about Chevron is that there was an international tribunal that ruled in favor of Chevron in an Ecuador case, and so in 2011 Ecuador ruled that Chevron violated regulations and we're going to force them to pay $9.5 billion in restoration costs. And recently the International Tribunal found that that ruling was the result of fraud and bribery, and so they ruled that Chevron doesn't have to pay back the $9.5 billion, which should help free up cash flow for Chevron to invest in new projects, and so that won't weigh as heavily on their balance sheet, which should help them out in the future.
So Valero, their business description is they are all downstream. They refine the oil and then they sell it. That's basically all they do. They were the largest refining company in the United States up until about a month ago when there was a merger against their two competitors, and it doesn't look like they're going to be the largest one anymore. Focusing solely on refining has allowed them to deal better with the market. As you can see, they've seen a lot of growth, and part of the reason is the refineries have the ability to produce different products in order to have them be more immune to the effects of recessions. So let's say the price of gasoline shoots up, they don't want to sell gasoline or something like that, they can switch to asphalt, and asphalt always deals better when the economy's down. So they can do that. It's called asphalt is king because it always saves the refineries' butts when the economy's bad. And then they're 3.8% of our portfolio. And then their free cash flow yield in 2017 was 10.10. And then we did use price per flowing barrel with this company because they don't have as much debt, they're more focused, they're not as much in the exploration, and they don't have a lot of investments that are pending right now. So it was more applicable.
So, do you have a perspective of when you might be more interested in looking at an integrated oil and gas company versus a company that just focuses on the downstream? Where in the economic cycle would it make sense to be more heavily invested just in downstream, or still thinking about that?
So like when the market is doing worse, it would be better to be downstream because they're still able to produce products that are still needed when the economy is doing bad. So like Joel said, they can produce asphalt instead of jet fuel, or and the military always requires jet fuel also, so there's always that demand for it, but just like commercial airlines will not have as big of a stock of jet fuel when the prices are high. And so being in the refining business, they're able to change what they're producing and still be able to make profit off of it even when the market's not doing well. So probably when the market's doing bad, they would.
They can also adjust the quality of their products also and sort of get away with that.
Moving on to the utilities sector. So the utilities sector is comprised of companies that provide or transmit electricity, gas, or water to businesses and consumers. This sector also includes companies that provide electricity through renewable energy sources such as solar or hydropower, and companies that generate and sell energy to utilities companies. If you look at our weighting, we're a little overweight in the utilities sector. We only have one building though, so it's not that big of a deal. Our 5-year return for utilities is doing much better, still not on par with the S&P 500, but they're at 39.19%, so better than energy right now. But currently you can see they're going through a bit of a flat period, but that shouldn't be too big of an issue because they tend to do better in the late and recession periods of the economic cycle, and so we should be entering that based off analyst estimates pretty soon, or have already started, so they should be turning around pretty soon. And then the sector is utilities. The industries included in that are electric utilities, gas utilities, water utilities, multi-utilities, independent power, and renewable electricity. And NextEra Energy is an electric utility, so it falls in that industry. And this is a defensive sector, so when the market does bad, it doesn't do as bad. It stays pretty consistent. It's a necessity. People need utilities no matter what is really happening with the market. And then some risk factors. There is an aging workforce, and so they estimate that about 50% of the workforce in the electric utilities industry is going to retire in the next 5 to 10 years. And they're also having trouble recruiting new talent because a lot of the tech companies are recruiting the top STEM graduates from universities, and so they're having trouble bringing in new engineers and new designers for their utilities. There's changing government regulation and policies, so that will affect them. And then they also have to upgrade their grid infrastructure to help it be less susceptible to hacking. That's been a big thing recently, is they're worried that electric grids could get hacked, and so whole cities could become basically dark, so they wouldn't have any power, so you could hack like New York City, and then that would cause just massive amounts of damage and massive inconvenience for people. Some special metrics that they use is just mean time to repair, so seeing how quick they are to respond to problems, the number of disconnections, so how consistent their network is, and then the electrical load. And so by seeing that, you can tell how stressed their network is, and they want to try to keep the load as low as possible so they don't have failures in their system. And then some of the emerging trends are planning for electric vehicles, and so they've started working on like smart charging, and so that's charging your electric vehicles when there's the least amount of load on your electrical grid, so that you don't have these peak times that just have massive amounts of load going through, which can cause failures. And then they're also adopting digital tools to increase energy efficiency. And so they're using software systems that can remotely monitor and troubleshoot power plants, so that they can keep them running at peak efficiency. And then they're also using predictive analytics so that they can sense if there's going to be a failure in the system and work to repair that before it happens, which is useful. And then Porter's 5 courses for electric utilities. Once again, there's really not too much threat of new entrants. It's a pretty already mature industry with not a lot of unserviced customers, and so there's not a lot of room for new electric utilities to come in and take advantage of. The threat of substitutes would be the highest, and so that would just be like people changing to solar power, wind power, hydropower, just that type of stuff, which they don't think will really be an issue. They don't think it can take market share for the most part until at least 2040. So electric utilities should be fairly safe until then. And there is the competitive rivalry among existing competitors. Yep.
So when you say the people doing solar, hydro, wind, you're talking about people going off the electric grid and doing it themselves at their house, like
yeah,
using
using solar panels and
okay.
wind turbine energy.
Not just the grid itself, like NextEra putting up their own solar panels, or like GBA putting
yeah,
a
it would
wind
be
farm
people
out.
changing from
Okay.
using electric utilities and switching companies,
Okay.
basically.
Okay.
Yeah.
Right, I gotcha.
And then yeah, there's so the bargaining power of buyers. A lot of these utilities service large areas, and so the buyers are always trying to get the best deal for what they're paying. But the more people you serve, the less power they have to really influence you to change your prices. And so most of these companies are serving full cities, and there's not a lot of risk of buyers changing over to different companies because there's not a lot of companies in each city, really.
So NextEra Energy is the only company that we have here. NextEra provides sustainable energy generation and distribution services. The company generates electricity through wind, solar, and natural gas. Through its subsidiaries, NextEra Energy also operates multiple commercial nuclear power units. So they have power plants, nuclear energy also. They've been doing very well recently. They've been performing better than any of the three companies that we have. We did have a little bit of trouble finding metrics on this company. You can see the ones that we talked about, we're going to have to basically read their entire 10K to find those numbers, it looks like. But they've been performing very well recently.
So for utilities, are regulations typically federal or set by state that influence the rates that utilities can charge?
State, right?
I think it's state.
Yeah, state and local service area. So one of the more important questions you might ask is what geographic area does this company serve? And is it an attractive place to serve? Not just in terms of demographics, like is it an area that has growing population, etc., but also how, since utilities typically have the rates that they can charge set by a regulator, how friendly is that regulator? And some states have additional requirements that these utilities have a certain percent of their power coming from renewable sources that maybe aren't as cost effective as traditional sources of energy. So are those in play? So those would be some questions I think you guys would want to ask if you guys are looking into NextEra and maybe comparing it to some of its competitors. Or not really competitors, since these utilities oftentimes have a monopoly in their area, but comparable companies. Okay? Any questions from the peanut gallery?
Yep.
I might have a question on the energy thing. So when you say, so for example, Valero, and then and you're talking like asphalt is saving this company and et cetera, et cetera. So when you have a barrel of crude oil and you refine it, you can't decide if you want to make more asphalt or more jet fuel, because when you refine it, you just get the top layer for jet fuel and then the bottom for asphalt,
Yeah,
right?
that's not true.
So is it not true?
It's not true. I worked at a refinery for 4 years, and you can do whatever you want with it. So when you're a refinery, you can decide what amount you want for each product. So let's say that they have a quota to hit because the refinery has already sold like several million units of asphalt, and they, just like that, type it in the computer, change the metrics, and then the refinery produces the asphalt from the crude oil.
Awesome, thank you.
So in this industry, scale is probably important, right? So what's your perspective on Valero, given that two of its competitors have just merged, or proposed merging?
I think they're going to do just fine. They've been performing really well, and from everything we've looked at so far, they're a pretty healthy company, and they've been shutting down a few places and then opening up new ones. I think they just opened up a new refinery in the Philippines, I believe, and that was for chemicals. So they are opening up new areas and investing and shutting down old ones that they don't see worthy anymore.
And then, while I think it's perfectly fine to use EV to debt-adjusted cash flow, you're still, for all these companies, going to want to look at their balance sheet and look at some of their like coverage ratios for paying off their like interest obligations or interest payment obligations and what kind of debt they've taken on. I get why you guys want to compare cash flow metrics like on an apples-to-apples basis, but in a low oil price environment like a year or two ago, there were some companies that were struggling with their debt loads, so it is something that you do want to be vigilant about. Okay. But, yeah. Any other questions? Okay. Good job, guys.
Ryan, can you press the red button?